All right, today we are diving deep into a really interesting way to invest directly in the engine room of India's growth. We're talking about the metals and mining sector. We're going to break down the Mirae Asset Nifty Metal ETF. So let's just start with a big picture, right? When you think about India's incredible growth story, it's literally being built out of steel, aluminum, and other core metals. Every skyscraper, every new highway, it all starts here. In this explainer, we're going to look at one specific way you can be a part of that foundational story.
So here's the game plan. First up, we'll explore why the metal sector in India is such a massive opportunity right now. Then we'll get into the nuts and bolts of how this ETF actually works. After that, we'll look at the government policies that are really pushing this sector forward, face the very real risks involved, and finally, help you figure out if this is something that might fit into your strategy.
So, why metals? Why are we even talking about this right now? Well, it's simple. You just can't have huge economic growth without them. They are, quite literally, the building blocks. And you know, this isn't some small niche industry we're talking about. It's a massive pillar of the Indian economy. I mean, look at this. India is one of the top global producers of aluminum, steel, and iron. This stuff fuels everything, new roads, new cities, and it's absolutely critical for the green energy transition and that booming EV market. The demand is just coming from everywhere.
Okay, so you're sold on the sector. But how do you actually get a piece of the action without becoming a stock-picking genius? Well, that's where this ETF comes in. Let's pull back the curtain and see how it works.
It's kind of like a recipe, right? The Nifty Metal Index gives you a precise list of ingredients. In this case, the top 15 metal and mining companies in India, and their exact amounts. The ETF's only job is to follow that recipe perfectly, buying and holding that exact same mix. It's a completely passive approach. So the key thing to get here is that this isn't about some manager trying to be clever and beat the market. The goal is to be the metals market. It just mirrors the Nifty Metal Index, trying to keep any difference in performance, or what they call tracking error, as small as possible. And you've got two main ways to invest. You can buy the ETF on an exchange just like a stock, or you can go through what's called a fund-of-fund, which is basically a mutual fund that just buys and holds the ETF for you. And wow, take a look at this. It really shows you who the big dogs are in this space. The index is super concentrated. Over 70% of it is just these 5 companies. We're talking Tata Steel, Hindalco, JSW Steel, Adani, and Vedanta. That means your investment's performance is going to be heavily tied to how these few giants are doing. And if we zoom in a little bit, you can see the main subsectors are pretty clearly iron and steel and aluminum. It's also really interesting to see the different debt levels. This is a super capital-intensive industry, and more debt can be a double-edged sword. It can seriously juice up your returns in the good times, but it can also amplify the losses when things turn south. Definitely something to keep an eye on.
Now, it's not just the economy chugging along here. Let's talk about the big external forces, especially the government policies that are basically putting wind in this sector's sails.
I mean, just look at this number. A major catalyst here is direct government support. The Production-Linked Incentive Scheme, the PLI scheme, for just specialty steel is expected to bring in about 30,000 crore rupees. That's a huge amount of capital being pumped into the industry.
And that money isn't just disappearing into thin air. It's meant to build something real. The goal is for that PLI scheme to help create around 25 million tons of new production capacity for high-value steel in just the next 5 years. And this isn't just a one-off thing. We're seeing a whole comprehensive strategy from the government here. You've got the huge national steel policy, you've got policies to boost recycling and efficiency, rules to increase mineral production, and even quality control orders. The message is pretty clear. They want to build up the entire domestic metals industry.
Okay, now for the reality check. We have to talk about risk. High growth potential almost always comes with a catch, and this sector is famously cyclical. That means its fortunes swing up and down with the economy, with global prices, and that can lead to some really dramatic performance swings.
And those swings can be massive. When this sector is hot, it is really hot. It doesn't just squeak by the broader market, it can leave it in the dust. In fact, it's beaten the wider Nifty 500 index in 5 of the last 10 years. And if you want a perfect example of just how wild this ride can be, look no further than this. Coming out of the 2008 crisis, the Nifty Metal Index shot up an incredible 232.5% in 2009. That shows you the kind of explosive upside that's possible. But you have to remember, a rocket that goes up that fast can also come down.
This slide really tells you everything you need to know in a nutshell. On the one hand, you've got these really powerful long-term returns from the index. I mean, almost 35% compounded annually over 5 years is amazing. But then, on the other hand, you have this big, flashing, impossible-to-miss warning, very high risk. That's the trade-off, right there.
And this brings it all back to today's reality. This fund is brand new, and since it launched, it's actually down. Now that's a really short time frame, so it's not a prediction of the future, but it's a perfect real-world example of that very high-risk warning in action. It's a reminder that this is not a smooth ride.
So let's put it all together. After seeing all that, the big question is, who is this actually for?
Look, the fund itself is pretty upfront about this. It's for an investor who wants to specifically bet on the Nifty Metal Index, who understands that this is a tactical play on a very cyclical sector, and this is the most important part, who can stomach a lot of risk and volatility. And one other thing to keep in mind is the tax situation. Because this is treated as a non-equity fund, any short-term gains are just taxed at your income tax rate, and long-term gains, so after 3 years, are taxed at 20% with indexation benefits. It's definitely not for someone with a conservative mindset or anyone who thinks they might need to pull their money out quickly.
So ultimately, it all boils down to this one question for you. You have the undeniable potential of India's industrial growth story on one side and some very real, very high volatility on the other. Is that a trade-off that you're willing to make for your portfolio? Well, that's a question only you can answer.